since March and April of 2025, almost every single broad-based metric of inflation on a year-over-year basis is re-accelerating back to the upside. What I do care about is that a bunch of other inflationary components are taking place. We have something like M2 growth on a year-over-year basis accelerating. We have loans and leases and bank credit accelerating on a year-over-year basis. We have deficit spending from the US government higher than it was 1 year ago, higher than it was 2 years ago, higher than it was 3 years ago. So just because inflation is going to be accelerating in and of itself is not necessarily bearish. On the contrary, we have a lot of evidence that rising and accelerating inflation is largely bullish. And so as investors, we need to ask ourselves a very simple question.
Caleb Franzen is the founder of Cubic Analytics, where he works as a market analyst focusing on macroeconomics, investing, and financial markets.
He left a career in corporate banking to build his reputation as an independent analyst and writer, often sharing insights and research through his Substack publication and social media.
And so at the time, that was basically a normalization of interest rates, bringing them back down to somewhat more of a neutral and less tight stance. And today we don't unfortunately have that environment, right? So when the Fed was getting ready to cut interest rates this time last year, they were looking at 3% real GDP growth contrasted versus 2.1% today. So again, this is not recessionary behavior by any sense of the imagination, but it is, I think, one of the risks that we're facing right now, probably less so than recession risk, is rate volatility risks. And what I've actually found is the less I focus on macro, the better I tend to do, right? So I just want to focus on what's really taking place in the market itself.
Hey guys, welcome back to Less Noise, More Signal. Today I'm happy to be joined by Caleb Franzen. It's nice to have you on the show, Caleb.
Thanks, Pascal. Really excited for this, man. Let's do it.
Yes, exactly. So I came across your name just recently, actually, on Twitter. Probably you were floating back in my feed every now and then. But I read this very interesting article that I will also link to in the show notes, where you were talking about like the rate cuts and how you potentially look at this. So this is something I want to talk about with you today as well. But maybe if you could quickly introduce yourself, who you are and what you're doing, that would be nice.
Yeah, of course. So my background is in wealth management, and then I worked in banking for several years, working up in San Francisco, helping to manage basically a $30+ billion commercial loan portfolio. In 2020, I jumped off and quit my own job. My passion has always been with markets, with investing, with talking about the Fed and monetary policy, so on and so forth. So I jumped off on my own in September of 2020, started Cubic Analytics, and here we are basically 5 years later, and the train keeps going. So that's basically the situation.
Nice. And Cubic Analytics, is it sort of an investment research firm, a fund, or what is it sort of?
Yeah, it's basically just sell-side investment research. And so the kind of key principles that I approach markets from really focus on combining what I'm seeing both in terms of macro, then talking about risk assets. So within risk assets, I mostly focus on what's taking place in US equity markets, and then also with Bitcoin. And so these three kind of core pillars are why I called it Cubic Analytics.
Okay, I see. Yeah, very interesting. Exactly the things we are focused on this show as well. So I think there's some great match here. I would like to get started, talking about yesterday's CPI. So people also know this was recorded just one day after the release. And I would be curious to know from your side, what are the takeaways from yesterday's CPI release?
The takeaways, unfortunately, seem to reaffirm one of the key concerns that I've been seeing from a macro side of things, which is that disinflation, which I was pounding the table on at the end of 2022 for all of 2023 and all of 2024, disinflation is gone, right? And in fact, what we've been seeing is since March and April of 2025, almost every single broad-based metric of inflation on a year-over-year basis is re-accelerating back to the upside. So we can look at, obviously, something like headline and core CPI, but we can also look at median CPI, which is exactly like it sounds, going to be tracking the median component within the CPI basket. We can also look at the trimmed mean CPI, showing the exact same dynamic. And so, the data that we got yesterday reaffirmed that inflation is continuing to accelerate. I'm pretty sure headline increased from 2.7 to 2.9% year over year. And some of the individual components that I'm really focused on, something like headline X shelter CPI, I think it's really critical to remove shelter, because it's 33% of the headline basket, but it's also the laggiest component, right? Per the Fed's own admission, owner's equivalent rent lags real-time housing market data by anywhere from 8 to 12 months. They can't even really give us an exact timeline for how much it really lags. And so when we strip out shelter from the equation, I brought a chart with me that I'd be super happy to share with your audience. Let me share my screen here. This is the chart. And so this is headline X shelter CPI. This is now hitting the highest levels, 2.5% year over year. This is the highest since April of 2023. The difference is that in April of 2023, we had significant disinflation, right? And so look, I want to be very clear. We have not reaccelerated enough in these inflation metrics to reach what I would perceive to be high inflation. So we can acknowledge that inflation is moderately accelerating and is still showing year-over-year inflation at a moderate pace. But what I'm really focused on from a macroeconomic perspective is the fact that these variables are accelerating, right? And if we look at something like headline CPI X energy, so this is actually different than core CPI because core is going to also exclude food as well as energy. In this case, we're still going to be including food in this variable and just excluding energy. This is also reaccelerating, right? And so these kinds of components are definitely a cause for concern for me. I want to acknowledge here very quickly, if we zoom in on this, if we look at March and April of this year, headline X shelter CPI was growing at a pace of 1.35% year over year. As of August, it's 2.5. That rate of inflation has almost doubled in a matter of 4 months. That's a pretty key concern here, right? So when we were looking at rate cuts coming into the picture last year, we were able to point to a significant amount of disinflation. It seems now that the Fed is getting ready to cut interest rates despite the fact that inflation is reaccelerating.
What if you could lower your tax bill and stack Bitcoin at the same time? Well, by mining Bitcoin with Blockware, you can. New tax guidelines from the Big Beautiful Bill allow American miners to write off 100% of the cost of their mining hardware in a single tax year. That's right, a 100% write-off. If you have $100,000 in capital gains or income, you can purchase $100,000 worth of miners and offset it entirely. Blockware's mining as a service solution enables you to start mining Bitcoin right now without lifting a finger. Blockware handles everything from securing the miners to sourcing low-cost power to configuring the mining pool. They do it all. You get to stack Bitcoin at a discount every single day, while also saving big time when tax season hits. Get started today by going to mining.blockwaresolutions.com/LNMS. Again, that's mining.blockwaresolutions.com/LNMS. Hey guys, I just wanted to let you know I published a new book, The Bitcoin Enlightenment, co-written with my buddy Daniel and none other than Mexican billionaire Ricardo Salinas. It's a deep dive into the monetary system and its future. In it, we make the type of connections that go beyond what you'll hear from your average Bitcoiner, MMT advocate, or macro pundit. So grab your copy on Amazon today. You'll find the link in the show notes. And now on to today's show. Yeah, that's some really great observation here. I think one of the takeaways for me then is, especially for people to take home, is like probably as of now, as you mentioned it yourself, it's not about the absolute level of inflation where we're at, but more so the rate of change, which is, it seems to be reaccelerating, and that could sort of spell somewhat trouble in the future. And I want to come to this as well. But maybe first, you mentioned inflation. It is not at a point where it's called or where it's considered to be high inflation. Where would you say, if that were to accelerate, would be this metric where it would be a high inflation and then potentially also just cause for some concern,
Sure. I think for me, it's really important to look at that headline X shelter variable. That's giving us, in my opinion, the best kind of real-time pulse that we can get for inflation dynamics. I don't really pay attention to trueflation because they're constantly changing the inputs into that model, and they generally lean towards somewhat of a Keynesian approach to an inflation output. And so it's food for thought. It's something interesting to look at, but it's not something that I'm significantly paying attention to. And so for me, headline X shelter is the key variable. Like we just acknowledged, it's currently showing a year-over-year rate of inflation of 2.5%. If that gets to like 3.5% to 4%, I think that would probably signify that inflation has reached kind of this high inflation regime.
And what do you make of like the tariffs? They've been in discussion all year long, like really people saying, okay, these tariffs at some point they will filter through, and now I feel like I read some studies from from people where they say like also retailers and like these companies, they're now saying, well, we were able to kind of put down inventories, but now we're running out of inventories. And that's why maybe now, starting in August to September, October, this could actually be passed on then to consumer, just because inventories where it was still cheaper because there were no tariffs when they were produced. This is now actually affecting people and the economy. What is your view there?
So I think it's too early to tell how much tariffs have had an impact on inflation, on deflation. It's such a hot button topic, right? Some people are dead set convinced that tariffs are going to be deflationary. Others are dead set convinced that it's going to be inflationary, if not hyperinflationary. I will refer to the comments made earlier this morning by the Restoration Hardware CEO talking about how the impact of tariffs is much bigger than people realize on inflation, and that most likely we're going to be feeling those impacts over the course of the next year, acknowledging that, these tariffs aren't just coming in 1 month, right? So I'm not sure. And even for me as an economist, or someone who likes to think of myself as somewhat of an economist, I can't actually quantify how much of an impact tariffs are having on inflation. I can't point to a specific contribution that they're making or not, right? So it's really hard for me to focus on that. What I do care about is that a bunch of other inflationary components are taking place. We have something like M2 growth on a year-over-year basis accelerating. We have loans and leases and bank credit accelerating on a year-over-year basis. We have deficit spending from the US government higher than it was 1 year ago, higher than it was 2 years ago, higher than it was 3 years ago. These are inflationary components, particularly in a backdrop where wage growth is still exceeding the rate of inflation. And that is going to allow producers, retailers, so on and so forth, to eventually pass on higher costs if they feel them to the end consumer. So I'm not sure. It's also not really a coincidence that I was highlighting what the year-over-year rate of inflation was for headline X shelter in March and April of this year, because that's essentially the pre-tariff standpoint, right? And so if we've seen that rate of inflation essentially double in a matter of 4 months before those tariffs came into effect, it's not maybe causation, it's a bit of a correlation, right? Amidst a backdrop of different dynamics that are taking place for inflation to reaccelerate. So I think this is one thing that a lot of people kind of glance over is inflation is multivariate, right? And so we can't just point to tariffs as being the inflation catalyst or not. We have to look at the totality of the evidence and take the weight of that evidence to basically forecast where inflation is likely to go. My assumption is, based on some of the data points that I just referenced, that inflation is going to continue to accelerate at a modest pace.
Yes, I see. And some people are also bringing in PPI. How do you square the fact that PPI came in like slowing down or seemingly, lower, with the fact that now on the consumer side, things are still seeming to reaccelerate? Can these two be square? Is there like squaring a circle, or does it add up for you?
The PPI data to me isn't that significant because it's not that significant for the Fed, right? And so if I
Right.
want to focus on macroeconomics and certain economic data points, I need to frame it within the lens that the Federal Reserve is going to be looking at those data points to make policy decisions. So the Fed is going to be hyper-focused on CPI and then looking for confirmation within PCE, because whatever's taking place within PPI, first of all, it's going to be very volatile, which we've already seen a lot of evidence of, may or may not filter into CPI inflation, right? And again, I would rather just focus on the actual catalyst that could be driving inflationary dynamics: M2 growth, credit creation, deficit spending, wage growth, so on and so forth, and let that be the basis for my forecast of inflation rather than what's taking place in PPI.
Mhm. Yeah, this is some great analysis as well. I mean, it makes total sense to be focusing on what the Fed is focusing on, and for me also what the market is focusing on. Because I offline, this is something that I was like telling you. I'm currently really challenging, or am being challenged by the fact that I have a hard time reading the market, because we have on this one hand, inflation, which is sticky or maybe even trending up, looking at the rate of change, but then we have the labor market, which is still very sort of slowing, and that's what a lot of people point to as well. The Fed is obviously also focused on the labor market as well, But as an investor, I mean, you now also pointing to the fact that inflation is reaccelerating. I think what you're hinting at is that at some point we just have to be cautious, because this could turn into a problem. But obviously, you never know when it will. And so my kind of question is, how do I need to understand what the market is focused on currently? Is it more looking towards like the labor market, which is slowing, or inflation that could spook it at some point? Yeah, what's your take here?
So let me start by sharing a very interesting chart that your audience will love. This chart here in blue is looking at the year-over-year rate of inflation in core CPI, and then in red, looking at the NASDAQ Composite Index. This chart goes all the way back to the 1970s. What I'm trying to highlight here and show is that we can experience accelerating rates of inflation in which we're going to have the NASDAQ 100 also rise. So just because inflation is going to be accelerating in and of itself is not necessarily bearish. On the contrary, we have a lot of evidence that rising and accelerating inflation is largely bullish. That often comes from somewhat of a Keynesian approach to economics where growth and inflation are going to be positively correlated. So if inflation is rising or accelerating, typically what we see, especially in the US economy where we have the world's reserve currency, is that economic growth in the United States is also at least going to be stable, strong, or reaccelerating as well, which is obviously going to be very accretive to asset prices. And so I think this chart right here is super important. And so I think to your point, right, we are seeing a market that is much more concerned or focused on the simple fact that the Fed is getting ready to cut interest rates due to labor market softness. I want to be very careful about the words that I'm using here because you'll notice I am not saying labor market weakness. I think the labor market as a whole continues to be resilient and dynamic. This is something that I've been pounding the table on since the end of 2022, all of 23, all of 24, and even in 2025, despite the fact that we just had the largest downward revisions in non-farm payroll in US history. I was also looking at the downward revisions that took place last year, acknowledging that yes, despite the fact that we had those revisions, we still had robust non-farm payroll growth. We had still robust ADP private payrolls. We still had robust unemployment rates, so on and so forth. And so as I look at those dynamics today, yes, the labor market is significantly softer than it was 1 year ago, but it's not weak, right? And I think that's really kind of the key thing to highlight here. And so because the market is just simply a forward-looking pricing mechanism, I think it's really important to focus on the signal that the market is telling us. And yesterday, we just had the Dow Jones close up like 1.3%, fresh new all-time highs for the S&P 500 as well. For the NASDAQ, we're seeing Bitcoin get back above 115,000. We're clearly seeing risk-on dynamics, and that does not typically happen during recessionary periods. That does not typically happen during downtrends, right? And so as much as possible, I want to align with the evidence that we're seeing in the market, which is that we are still in a very strong bull market. I only focus on macroeconomics so I could hopefully be a better investor. And what I've actually found is the less I focus on macro, the better I tend to do, right? So I just want to focus on what's really taking place in the market itself.
Yeah, that's also something I've been hearing from others. You can get really down into the weeds and then sometimes even miss the forest for all the trees, so to say, and that's why you want to be focused on what you're good at. I mean, in terms of these rate cuts that you were referencing, or like people are now expecting, I mean, the market is looking at, I think now 92% or something for a rate cut, I guess, from when I last checked. What is your belief there? Next meeting, next week, will we see maybe potentially even a 50% cut because of the softening of the labor market, or what is your take?
So for me with monetary policy, I'm again always going to defer to the market. And I tend to think that the short duration treasury market is the best estimate for what the Federal Reserve is likely to do. And so for me, I tend to focus a lot on something like the 1 month and the 3 month treasury yield. And both of those are forecasting officially now for the past few weeks that we should be expecting a 25 basis point rate cut. Obviously, we have that meeting taking place next Thursday. So perhaps you can make the case that a lot is going to change between now and then and that the market could price in 50. But for right now, all we know for a fact is that the bond market is telling us to expect a 25 basis point rate cut and that we should generally expect a new rate cut regime to be on the horizon. And so that for me is what I think is important. I don't pay attention to the CME FedWatch tool. It's given too many false signals in the past. It just so happened to be right this time. Congratulations. But for me, I'd rather be late and consistently right than early and potentially wrong. And so for me, I was waiting for the signal from the 1 month and the 3 month treasury yield. Both of those now are confirming rate cuts are coming.
Okay, I see. Interesting. But in terms of what type of rate cuts, because that's also something that you were talking about in this article that I mentioned in the beginning. And, I know other people have been writing about this. Obviously, there's like recessionary cuts, there's like these disinflationary cuts that you mentioned. There's like something called normalization cuts. So what type of cuts will we have this time around? And what could this also mean for the market then?
I love this question because I just wrote a 4,000 word report on it on Saturday for free for investors to read over at cubicanalytics.substack.com. And then I wrote another 4,000 word report for premium members of Cubic Analytics on Sunday, talking about what they can do about it as investors. So this has been the key kind of topic on my mind, and I'm happy to share. some of the things that are taking place. Because as I look at the weight of the evidence, we are not seeing disinflation in this market. What we're looking at right now is median, trimmed mean, headline, and core CPI all on a year-over-year basis. What we're looking at in this chart is what the Federal Reserve was seeing evidence of this time last year as they were getting ready to cut interest rates. So all of this data is as of August 2024, looking at year-over-year inflation rates. And what we can see, looking at all four of these different data points for broad-based inflation, is that we had firm evidence of disinflation. All of these data points were decelerating on a year-over-year basis. Let's look at this data point today. Almost all of them are reaccelerating since March and April of 2025 on a year-over-year basis. And so again, based on the evidence that we're seeing in something like headline CPI X shelter, headline CPI X energy, these data points are reaccelerating, right? And so last year, when I was looking at the upcoming rate cut environment, I was able to come to a conclusion that, hey, these are actually disinflationary rate cuts. The Federal Reserve is not cutting interest rates in response to a crisis. They are cutting interest rates because they've now seen the whites of inflation's eyes, right? We're going to remember that as being a key phrase that Jerome Powell and many Fed officials were using a year ago. And so at the time, that was basically a normalization of interest rates, bringing them back down to somewhat more of a neutral and less tight stance. And today we don't unfortunately have that environment, right? So yes, labor market conditions have softened pretty substantially. Again, they're still not weak, at least not yet. And we no longer have disinflation intact. And so as I've been trying to kind of look at that backdrop being very different than it was actually 1 year ago, I think that the unquestionable bullishness that I had 1 year ago is more in question today, right? So the outlook that I have as an investor is not bearish. I want to be very clear because we are in firm uptrends across the entire risk asset spectrum, but it's just less bullish than I was 1 year ago. And I think that's the key thing for investors to recognize.
Yeah, I mean, that makes total sense. In the end, I'm asking myself, really, is it really that different? I see your point in terms of like the rate of change, it's pointing upwards and everything. But in the end, we can only speculate. We never know if it's really going to pick up like extensively, and obviously none of us know, because if it weren't, then I guess, we could again maybe liken it to sort of normalization cuts, maybe not to the same extent as last year, but still sort of rate cuts that are somewhat bullish, because like obviously there's probably going to be other drivers in terms of disinflationary drivers as well that we might have to factor in, and there's many that we could probably list as well. But so yeah, that's what I'm seeing. So in the end, nobody really knows, but it's just interesting to think about that there's like interest rate cuts. It's not always like either bullish or bearish. So you have to look at the type of cut that we're dealing with, sort of.
I still think it's bullish, right? But that bullishness or bearishness is kind of a spectrum, right? So it's not just completely binary. So it's just, in my opinion, less bullish than it was last year. And look, it's also really important to contextualize what's also taking place in the labor market. Because again, I was also referring to those disinflationary rate cuts last year. I was also referring to them as non-recessionary rate cuts. Again, I still don't think that a recession is coming, but let's just kind of look at the objective facts here, right? 1 year ago, when we were looking at average job creation on a trailing 6-month basis, the ADP private payrolls was showing 119,000 jobs per month. The non-farm payroll was showing 133,000 jobs per month. Let's contrast that versus the August of 2025 data. The pace is basically half, 62,000 for ADP, 64,000 for non-farm payroll. Let's look at the trailing 3-month data. We went from 119,000 for ADP to 45,000 today. We went from 82,000 in non-farm payroll to 29,000 today, right? So we are seeing a pretty material deceleration. We can also look at something like real GDP growth measured on a year-over-year basis. When the Fed was getting ready to cut interest rates this time last year, they were looking at 3% real GDP growth contrasted versus 2.1% today. So again, this is not recessionary behavior by any sense of the imagination, but it is softening behavior, and that's something to be very cognizant of.
No, that's great as well. I mean, that's exactly what I was alluding to when I was really pointing to this challenge between labor deteriorating as well as inflation trending up, because like judging from what we're seeing here, with the payrolls and everything, I feel like the market is somewhat justified in pricing in more rate cuts also extending into 2026, and I was looking at the CME Fed Watch tool yesterday again, just to see like how this has changed. And even if we look at it over maybe a month's period, I mean, they have started to more aggressively price these cuts in, I think, to the extent that in September 2020, the market is seeing somewhat maybe more than 150 basis points that the Fed has cut by then, which is quite a lot, And I think that's where the risk is at. Labor market wasn't to deteriorate that much as maybe some people think, and at the same time, inflation is picking up again. Then maybe some of this has to be walked back again in early 2026, and that could be where the market is being shown, or I would say where it has to kind of caution itself again, But that's certainly something we have to be cognizant of, right?
I do agree with that, because the last thing that the Fed wants to do is flip-flop on monetary policy, right? They clearly have PTSD from the mistakes of Arthur Burns back in the 1970s. They do not want to go from an extreme tightening cycle to an extreme rate cut cycle and keep flipping quarter after quarter, right? This is not what they want to do. This is why they put so much emphasis on forward guidance, is that they want the market to be prepared for a consistent message, recognizing that the Fed is going to be data dependent. And so I do recognize, I think one of the risks that we're facing right now, probably less so than recession risks, is rate volatility risks, right? So if we are going through a period where the Fed cuts this upcoming meeting here next week, and then maybe one or two other times this year, but then we're looking at inflation at 4% on headline X shelter in the middle of next year, what is the Fed going to be doing in that environment, especially if the labor market is strong, right? They're going to probably retighten monetary policy, and that kind of flip-flopping could present a risk for the markets. And that's one of the reasons why I'm not bearish on equities. I'm certainly not bearish on Bitcoin. I have a bullish outlook, but I do think we should probably expect a little bit more volatility.
Yes, that's great. Yeah, I mean, to your point of not being bearish, I mean, I also saw this other chart, like where they kind of try to assess sentiment among investors, this AAII. And there I feel like this has been upticking as well, and this early is the highest since early May, which also, again, to me is sort of the Fed is probably going to cut now, and then a lot of people are maybe a little bit too bearish. So for the time being, it might not be the time to turn max bearish yet. You mentioned this about the market, being in an uptrend, and I think we can see it across many sectors, industries that this is going on. I would also be interested in how do we reaffirm that the trend is still going on? And then maybe what are you looking at? Can you maybe add some more meat to the bone in terms of also maybe actual metrics and ways that you're trying to assess if this trend is still going?
Absolutely. So first of all, a bull market is just an uptrend, right? And what is an uptrend? An uptrend is a sustained production of higher highs and higher lows. Some investors, some traders are going to call them stair-step behavior, because they're going to look like a set of stairs, just continuing to go up and to the right. And so I think one thing that's really important for investors to recognize is, again, if bull markets are uptrends and uptrends require the production of a higher low, that means that we are going to experience normal and healthy consolidations and corrections within that bull market, within that uptrend, going on to eventually produce a new set of higher highs. And so I do think that kind of context is really important. Let's go ahead and look at what the market is actually showing us, because we have very firm evidence of uptrend behavior, and it's without question. So let's go ahead and look at the Dow Jones. After we get these breakouts from a multi-month or multi-quarter consolidation, they tend to beget new highs, right? So strength begets more strength in the market. I've been targeting the 161.8% extension, which basically puts the Dow Jones at 50,300 at the index level. And look, we're going to go through and rattle off a bunch of charts here, because it's not just the United States that's breaking out to new all-time highs. We also have something like emerging markets, ex-China, breaking out of a 4-year base. I don't care what the reasons are for why this is happening. All I care about is that it is happening, because for whatever reason, investors around the world are willing to value emerging market stocks at the highest price of all time, right? And so I don't need to care about what the reason is. All I care about is the fact that it is happening. I was highlighting this breakout in advance. I was highlighting it when we got it, and we've continued to see an extension of higher highs and higher lows all through this frame of mind, right? And so look, let's focus just on US markets. I'm going to rattle off like 10 charts here. We're going to go really fast, but just bear with me. We can look at value stocks making new all-time highs. We can look at high dividend stocks making new all-time highs. We can look at dividend growth stocks making new all-time highs. Cash flow growth stocks making new all-time highs. And if cash is king, if asset prices are just a function of future cash flows brought to the present by an interest rate, then cash flow is a great way to measure that. And so the market is actually rewarding companies with great fundamentals. We have momentum stocks making new all-time highs. We have NASDAQ disruptor stocks making new all-time highs. Quantum computing stocks continue to make new all-time highs, cloud computing stocks, new all-time highs, semiconductors, new all-time highs literally yesterday. And so as we look at the weight of the evidence, we're seeing broad-based accelerations to the upside. We're seeing broad-based uptrend confirmations. And again, that does not happen during bear markets. It happens exclusively in bull markets, right? I was taught if you want to be an investor, and specifically a successful investor with the goal of making money, you should probably do everything you possibly can to be long during bull markets.
Yes, I see. No, that's so interesting that we're seeing it across the board. In terms of these actual charts that you were showing us, for some, do you also zoom in and then try to look at some metrics, just to assess trend in terms of like, are you looking at daily moving averages? Are you looking at some other metrics across these charts? Maybe if you could share with us what you're actually looking at when you zoom in, that would help as well.
Sure. So if we want to just approach markets from being a medium to long-term investor, right? I think it's really important to probably always have 3 moving averages on your chart, specifically on a daily basis. For me, I use the 21-day EMA, the 55-day EMA, and the 200-day EMA. And look, what are moving averages? They're just a smoothing mechanism of price. And in my opinion, price is the best signal because it represents the aggregate expectations of all market participants based on all known and unknown risks. So in my opinion, asset prices in and of themselves are the best crystal ball that we have available to us as investors. And so if we're going to smooth those out, we're going to kind of dilute some of the signal that we're just getting purely from price. But here's where I think it is really important is to basically confirm or negate the fact that we are in an uptrend. And so the way that we can verify this is we know for a fact that all uptrends ever, regardless of the asset, are going to have the price of that asset trading above its short, medium, and long-term moving averages. And then within that context, we're going to see the short-term moving average above the medium-term moving average and the medium-term moving average above the long-term moving average. And so that's what I'm trying to do by looking at something like the 21, the 55, and the 200-day moving average is give me that short, medium, and long-term length and then confirm where is price relative to those moving averages? Where are those moving averages relative to each other? And are they giving us strong uptrend confirmation? And across the board right now, basically, regardless of the asset you're looking at, the answer is yes, they are.
Yeah, that's very interesting. Is there maybe something else you can share with us that people might not be that familiar with? Because I guess in the end, the moving average is obviously a lot of people know. And I guess like if you get into trading, this is something you usually hear. Obviously, this may be also getting somewhat into the secret sauce of what you're doing. But if you were able to share maybe something you think, yeah, that's something investors generally might not have on their table, so to say, and you were able to share with us, that would be great. Yeah.
Yeah. So look, I'm an open book. I do want to clarify though, one thing is I think simplicity is a beautiful thing, right? And so, yes, a lot of people are familiar with moving averages. Unfortunately, I think they tend to use them in the wrong ways. And so finding a way that's going to be useful to you is really important. For me, using them as uptrend confirmations or downtrend confirmations or trend deterioration are really significant, right? And so of course they can act as dynamic support or resistance depending on the nature of the trend. But I think, again, simplicity is very significant, right? But let's talk about some of the secret sauce. And I'm definitely an open book, so I'm more than happy to share some different things that I'm seeing. Let's talk specifically about Bitcoin and one of my favorite indicators, which is the Williams %R oscillator. It's something that I think a lot of technicians don't focus on. It's something that basically no other analyst on X does talk about. And it's something I've really tried to popularize over the years. And again, we're going to focus specifically on the signal that I'm seeing with Bitcoin right now. This is something that I shared on X just 2 days ago. So this is not necessarily secret sauce. I don't have secret sauce. I share all of it with investors. So, if you're looking for absolute transparency, this is something that I'm actually using to make investment decisions myself. And that's something that I've been following through on. And so what we're looking at here is the price of Bitcoin going back to the end of 2022 or the beginning of 2023. And we're looking at the 60-day Williams %R oscillator. So why am I using 60 days for the price of Bitcoin? Because it does trade 24/7, 365. This is giving us a 2-month range, right? And so the Williams %R oscillator, what it does is in this case, it's going to be tracking the highs and the lows of price over a 60-day period and where price is with respect to those 60-day highs and lows. And so the thing that I'm really focused on here is what I refer to as a full oscillation from overbought, which is the upper bound, to oversold, which is the lower bound. And what I've been doing is I've been calling these accumulation signals. These are not necessarily bullish signals in and of themselves, but what they are doing is giving investors a statistical opportunity here to accumulate Bitcoin when it's oversold in an uptrend. And that is essentially the production of a higher low, buying an uptrend in oversold conditions, right? I think that's a beautiful and simple way to put it. And so as we look at this indicator, this just flashed at the end of August. This is something that I was talking about with premium members of Cubic Analytics in the middle of August, highlighting this as something to be aware of and something that I was actually going to be using to stack Bitcoin for the first time since March of 2025. And so the last time I bought Bitcoin was at like 78, 79,000. And I bought it again for the first time at 111. I bought more at 108. I bought more at 109. This is the first time I've been stacking. Why is that the case? Because the last time this signal flashed was in February of 2025. So I used that signal at the time to my advantage, accumulated cheap Bitcoin below 80,000 and let it rip back to 124. So I think this is a great signal for investors to be aware of.
I see. Very interesting. Yeah, I never heard about this indicator before. So, but just to maybe understand it a little more deeply, what is it? It's based on price, I guess, in the end. It's just, it's a price indicator sort of. And then if true, how would it be different from something like RSI? Can you maybe shed some light there?
You know, funny enough, the RSI indicator is going to look somewhat similar to the Williams percent R. The difference is the Williams percent R is an oscillator. So even if price is kind of going sideways, you might see the RSI cool off a little bit, but it might not necessarily reach oversold conditions. Whereas the Williams percent R, at least in my opinion, does give a little bit more of that signal. And in this particular case, that indicator, like I'll look at the RSI, for example, specifically for divergences, especially bullish divergences within an uptrend. But we're not going to be really getting divergences within the Williams percent R oscillator. I'm purely using it for signals for momentum thrusts and for oversold conditions.
Yes, I see. Interesting. Yeah, that's great. I mean, in the end, and you will probably subscribe to this as well. It always comes down to confluence, that you want to see in multiple indicators. It's not just that you want to use one of these indicators exclusively to your advantage and then trade off of this like solely. But I guess if you can hook it up with other indicators and that might be showing a similar thing, and you at some point feel like, okay, this is giving me confidence to move into the market. I think that's probably how a professional trader or investor does it anyways. Yeah, look for this confluence across different indicators.
Yeah.
Yeah, interesting. Well, I mean, I want to come to a close here because I think we learned a lot and we got to have time to digest this. But I mean, you mentioned it because it's a key question that I'm hearing myself, a lot of people. I had this interview that I published just recently, yesterday on my channel, with Henrik Seberg. He's a macroeconomist, and he's really about the fact, he's really vocal about the belief that we are in this biggest bubble ever, and this is about to pop, and he's arguing that the economy is a super tanker, and all his leading indicators and no coincident indicators are now flashing, and that's why he thinks recession is going to be coming our way. You already mentioned that you don't think there's going to be a recession, but if you zoom out, what do you think of this view? And also tying it to the business cycle that a lot of people think it's coming to an end, because liquidity cycle, business cycle, it's been extended. Are you paying attention to this at all, or are you taking it one step at a time, so to say?
Look, I hope we're in a bubble. I own a lot of equities. I own a lot of Bitcoin, and that means that my assets are going to go up a bunch if we're in a bubble, and I'll have the opportunity to sell them at higher prices. So if we're in a bubble, I hope we are. I'm long, right? I'm certainly not short. So, I'm not familiar with what Henrik is saying right now. I think he's a great marketer, so I'll leave my comments at that. But, I think, look, right now, generally speaking, we are just seeing some softness in the economy, but we're still seeing a lot of robust data. We're seeing retail sales from the Red Book data still showing really strong growth on a weekly basis, looking back on a year-over-year metric. And so data isn't perfect, right? And I think this is where a lot of investors who rely on macroeconomics get lost in the sauce too much, because we have to remember, in every single economic environment ever, there's always going to be bad or weak data points, right? And this is the key thing. And so bull markets, there's a phrase, bull markets climb a wall of worry. That phrase exists for a reason, because there is almost always a wall of worry. And the market tends to dismiss a lot of things or see through them. And so as investors, we need to ask ourselves a very simple question. If the market is not concerned about our fears or the things that we deem to be risks, but we're focused on making money as investors in the market, who's the sucker at the table, right? Is it us, or is it the other aggregate expectations of investors? And so I've learned over the years that it's always best to align with what the market is telling us and then have a set of criteria to adapt. If the market changes its mind, I can change my mind. I can change my positioning as an investor. All I know right here, right now, is we are in strong uptrends across the board. And generally speaking, we know this for a fact. We can look at the data. Asset prices trend. So as much as possible, I want to have the wind in my sails. There's a phrase that I've been using a lot recently, which is I would much rather be a salmon trying to swim downstream than a goldfish trying to swim upstream, right? So let's give ourselves the best chance of success here.
Yes, yes. Interesting analogy as well. Well, I mean, Caleb, I think that's pretty much what I wanted to ask you. So thanks a lot for this, yeah, swift crash course on how you look at markets. Amazing. If people want to follow you and maybe potentially learn from what you're doing and maybe even follow your calls, how can they do so?
Just come check me out over on X at Caleb Franzen. I'm posting a lot over there, all new market data that's coming out, the charts that I'm focused on. If you like what I'm talking about, come sign up for the free newsletter over on Substack. It's cubicanalytics.substack.com. And just come check me out. So I'm sure if you guys like what we talked about here today, a very well-rounded approach to looking at markets, to looking at macro, you'll love what I'm talking about over on those two sites.
That's great. Yeah, I can only recommend for people to head over and check Cubic Analytics out. Well, thanks, Caleb. Thanks a lot for doing this. Enjoy the rest of your day and talk to you soon again.
Thank you for having me. It means a lot.